Disclaimer.
AG here, your Asian guy breaking down the financial moves Wall Street won't explain. And trust me, when I'm warning Americans about what China just armed, you know it's serious. Let's dive into the $8 trillion weapon most people don't even know exists. Pop quiz. What happens when the world's second largest economy suddenly stops buying your debt, starts hoarding the one asset you can't print, and builds an entirely new financial highway that bypasses your currency altogether? You're about to find out because China just armed all three weapons simultaneously, and November 2026 is when they've scheduled the trigger pull. Here's what should grab your attention right now. While you were watching headlines about trade tensions and tariffs, China executed three coordinated financial moves that most Americans have no idea just happened. These are not future threats or theoretical scenarios. These are completed actions that have already repositioned $8 trillion away from our financial system. Let me show you the first weapon. China's holdings of U.S. Treasury bonds just hit a 17-year low. According to the U.S. Treasury Department, as of October 2025, China holds $688.7 billion in our debt. Think that sounds like a lot? It used to be $132 trillion at the peak. They've dumped 47% of our bonds while we weren't paying attention. That's not gradual portfolio adjustment, that's systematic liquidation. But here's where most analysts stop looking, and that's exactly where the real story begins. You see, when someone sells an asset, they're not just getting rid of something, they're buying something else with that money. So what has China been buying while quietly exiting our treasury market? Gold. Mountains of it. The People's Bank of China just completed its 13th consecutive month of gold purchases. 13 straight months of accumulation while simultaneously dumping our bonds. The World Gold Council estimates China now holds over 5,000 tons of gold in reserves, though the actual number is likely far higher, because China doesn't report all its purchases immediately. Think about what that means for a moment. They're converting dollars that depend on our government's promise into physical metal that exists regardless of what any government does. Here's the percentage that tells the real story. According to official Chinese reserve data, gold now represents 7.7% of their total foreign reserves. That's the highest percentage in modern Chinese financial history. When the world's largest manufacturing economy starts preferring metal over paper, that's not just portfolio diversification, that's a vote of no confidence in the currency they're leaving behind. Now, you might be thinking, okay, they're selling our bonds and buying gold. Countries rebalance reserves all the time, right? That's where the second weapon comes in, and this one most Americans have never even heard of. It's called SIPS, the Cross-Border Interbank Payment System. If that sounds boring and technical, let me translate what it actually does. It's China's answer to SWIFT, the payment network that processes almost all international dollar transactions. Here's the number that should make every American investor pay attention. SIPS has now processed a cumulative $94 trillion since its launch. Not billion, trillion, with a T. The Bank for International Settlements reports that CIPS now has 1,683 participating financial institutions spanning 124 countries. Think about your own international transactions for a moment. When you wire money abroad, when businesses pay foreign suppliers, when oil trades hands between countries, almost all of that traditionally moves through dollar-based systems. SIPS provides an alternative highway that bypasses our currency entirely. But even SIPS is old news compared to what just went operational in 2024. It's called mBridge, and this is where the three weapons converge into something genuinely unprecedented in modern financial history. mBridge is a digital currency platform that enables instant cross-border settlements between central banks. The people, this Bank of China, announced full operational status in October 2024. What does instant settlement mean in practice? It means two countries can trade with each other, pay for goods, transfer billions in value, and complete the entire transaction without a single dollar changing hands. No correspondent banks in New York, no SWIFT messages, no U.S. oversight of the transaction whatsoever. According to official Chinese financial data, the digital yuan processed through these new systems hit $2 trillion through September 2025. That number has doubled in just 14 months. You're watching the architecture of dollar-free international trade being built in real time, and it's already processing trillions. Now here's where these three weapons combine into something that should concern every American holding retirement accounts, treasury bonds, or frankly, any dollar-denominated assets. In late 2025, the Chinese government issued a directive to all state-owned enterprises. The order was specific, and the deadline was firm: complete divestment from Western markets by November 2026. State-owned enterprises aren't small players in China. They represent the commanding heights of the Chinese economy. Energy companies, banks, telecommunications firms, manufacturing giants. When you add up all Chinese state-owned enterprise holdings in Western stocks, bonds, real estate, and business assets, you're looking at approximately $8 trillion in total exposure. $8 trillion. dollars. They've been ordered to liquidate all of it by November 2026. That's not a suggestion or a recommendation. That's a government mandate with a specific deadline attached. Now let me put this in perspective with a scenario you can visualize. Imagine you're planning to sell your house. You list it. You take your time. You wait for the right buyer. You negotiate the best price. That's normal market activity. Now imagine the government tells you that you must sell your house by a specific date 11 months from now, and there are thousands of other people in your neighborhood who just received the exact same order with the exact same deadline. What happens to prices when everyone has to sell at once? That's the situation facing Western markets, except instead of houses, it's stocks, bonds, and business assets. And instead of thousands of sellers, it's the coordinated liquidation of the world's second largest economy's institutional holdings. Think about what you're witnessing here. China dumps 47% of our Treasury bonds. That's weapon one armed. They accumulate 13 straight months of gold while converting away from dollars. That's weapon two armed. They build an operational alternative to the entire dollar-based payment system and order $8 trillion in systematic liquidation. That is weapon three armed. These aren't three separate events. They're three components of a single coordinated strategy. The timing isn't coincidental, the trajectory isn't random, and the November 2026 deadline isn't arbitrary. You know what's remarkable about all of this? Most Americans have no idea these weapons exist, let alone that they're already armed and operational. The Treasury selloff gets buried in monthly data releases. The gold buying appears in obscure central bank reports. The payment systems launch with technical names that sound boring to most people. The divestment order gets announced in Chinese, reported in Asian financial press, and largely ignored by American media. But the institutions aren't ignoring it. Goldman Sachs just revised their gold price target to $4,900 per ounce by the end of 2026. That's from the current $4,045 level. When major banks start projecting 21% gains in gold within 12 months, they're not basing that on jewelry demand. They're positioning for something bigger. Here's what every American needs to understand right now. This isn't about whether you like or dislike China. This isn't about politics or ideology. This is about $8 trillion in coordinated selling pressure that has a firm deadline attached, combined with the largest gold accumulation in modern history, combined with an operational alternative to our entire monetary system. The weapons are armed, the timeline is set, and most people are still completely unaware that any of this is even happening. Now I know what you're thinking. This sounds like speculation, like connecting dots that might not actually form a pattern. So let me show you why this isn't theory. It's history repeating itself with mathematical precision. 3 times in the last century, major powers used these exact same financial weapons against the dominant currency of their era. And all 3 times, the results were catastrophic for anyone who didn't see it coming. Let's start with the precedent that should terrify anyone paying attention. Germany, 1900 to 1914. At the turn of the 20th century, the British pound sterling was the undisputed global reserve currency, just like our dollar today. Britain controlled the world's financial system through the City of London, and everyone assumed that dominance was permanent. Everyone except Germany. German financial records from this period tell a fascinating story. Between 1900 and 1914, Germany systematically reduced its holdings of British pound-denominated assets by 60%. At the same time, the Reichsbank was accumulating gold at unprecedented rates. Sound familiar? According to economic historians at the Bank for International Settlements, Germany's gold reserves more than doubled during this period, while pound holdings collapsed. But here's the detail most people miss about this repositioning. Germany wasn't just selling British assets randomly. They coordinated the liquidation with the construction of alternative trade relationships. The Berlin to Baghdad railway project was not just about transportation. It was about creating a trade corridor that bypassed British-controlled shipping routes and British-controlled financial settlements. German banks opened branches throughout Eastern Europe and the Ottoman Empire, creating a parallel financial network where marks and gold could settle trades without touching London. Think about what German industrialists were doing during this period. Krupp Steel negotiated direct bilateral trade agreements with Russian suppliers, settling in marks and gold. Deutsche Bank financed infrastructure projects across the developing world with the explicit condition that financing and payments would flow through Berlin, not London. By 1913, Germany had constructed a shadow financial system that could function independently of British sterling. Here's what most history books don't emphasize about World War I. Yes, it started with an assassination in Sarajevo, but the financial collapse that accompanied the war's outbreak in August 1914 was not just a byproduct of military conflict. Germany had spent 14 years building an alternative financial architecture centered on gold and bilateral trade agreements that bypassed London. When the war started, Britain discovered it could no longer simply print pounds to fund the war effort because too many countries had already repositioned away from sterling. The pound's dominance never fully recovered. The Bank of England's own archives reveal the panic that set in during August 1914. They had to suspend gold convertibility, something previously unthinkable for the world's reserve currency. British government bonds that had traded at premium prices for decades suddenly required significantly higher interest rates to find buyers. Countries that had been reliable holders of British debt were suddenly absent from auctions. Why? Because Germany had spent 14 years convincing them to diversify away from pound dependence. Think about that timeline. 14 years of systematic repositioning. Then a trigger event that exposed the vulnerability. We're currently in year 3 of China's systematic repositioning with a hard deadline set for November 2026. The parallel should make every American investor extremely uncomfortable. Now let's jump forward to a precedent you might actually remember if you were investing in the 1980s. Japan, 1985 to 1987. After the Plaza Accord forced the yen to appreciate, Japan found itself in a similar position to where China sits today. Massive dollar reserves, growing resentment of American financial dominance, and a desire to rebalance away from dollar dependence. According to Federal Reserve archives, Japanese institutions reduced their U.S. Treasury holdings by approximately 40% between 1985 and October 1987. The selling was gradual at first, orderly, nothing that screamed crisis, right up until it wasn't gradual anymore. Let me paint you the picture of what October 19th, 1987 actually looked like on the ground. Trading floors in New York opened to absolute chaos. The Dow Jones Industrial Average started dropping immediately at the opening bell, and it didn't stop. By mid-morning, the decline was already historic. By afternoon, it was apocalyptic. The index lost 508 points in a single day, a 22.6% decline, 6%. To put that in today's terms, that would be like waking up tomorrow and watching the market drop over 10,000 points in 6 hours. But here's what was happening behind those numbers. According to the Federal Reserve's post-crisis analysis, Japanese institutional investors had placed massive sell orders that hit the market in coordinated waves. These weren't retail investors panicking. These were institutions executing predetermined liquidation strategies. The Brady Commission, which investigated the crash, found that computer-driven selling programs amplified the decline. But the initial trigger was sustained foreign institutional selling that overwhelmed buyers. Portfolio insurance strategies, which had seemed sophisticated and safe just days earlier, collapsed into a death spiral. When prices dropped, the programs automatically sold more. That selling dropped prices further, triggering more automatic selling. Within hours, $1 trillion in market value evaporated. Retirement accounts that looked secure on Friday were devastated by Monday evening. Here's the part that should concern you about the China situation. The 1987 crash happened with about $40 billion in coordinated foreign selling as the catalyst. China is planning to liquidate $8 trillion on a set timeline. That's 200 times the scale of the trigger that caused the worst single-day crash in market history. Now let's look at the most recent precedent, and this one you definitely remember because you probably felt it in your energy bills. Russia, 2020 to 2022. Starting in 2020, Russia began systematically dumping U.S. treasuries and converting to gold and alternative currencies. By mid-2021, Russia had reduced dollar-denominated assets to just 16% of its reserves, according to the Russian central bank's own data. Then came the weapon deployment. When tensions escalated in 2022, Russia didn't need tanks to devastate European economies. They turned off the gas pipelines. Natural gas flows to Europe dropped 70% virtually overnight. The result? European industrial production collapsed by 30% in sectors dependent on Russian energy. Germany's chemical industry, the foundation of their manufacturing base, faced existential crisis. Let me give you a specific example of what this looked like for regular companies. BASF, the world's largest chemical company and a cornerstone of German industry, had to shut down ammonia production facilities that had run continuously for decades. Why? Because natural gas wasn't just their energy source, it was their raw material. Without Russian gas, the chemical reactions that produce fertilizers, plastics, and pharmaceuticals couldn't happen at economically viable costs. European electricity prices didn't just rise, they exploded. German households that paid 30 cents per kilowatt hour in 2021 were suddenly facing prices over €1 per kilowatt hour. That's not inflation, that's a tripling of the foundational cost of modern life. Small manufacturers across Europe simply shut down because they couldn't afford to keep the lights on, let alone run production equipment. What's the connection to China's current positioning? Russia proved that you do not need military conflict to inflict massive economic damage if you control critical resources and have alternative financial infrastructure in place. China watched that playbook very carefully, and they're now executing a far more sophisticated version with 3 weapons instead of 1. Russia controlled energy. China controls manufacturing, holds massive dollar assets that can be liquidated, and has built a complete alternative payment system. The potential impact is exponentially larger. Now, let me show you the current quantifiable evidence that removes any doubt about what's happening. These aren't projections or estimates. These are hard numbers from official sources that prove the timeline is already in motion. The digital yuan, officially called ECNY, processed $2 trillion in transactions through September 2025. That's according to the People's Bank of China's own quarterly reports. Here's the number that should grab your attention. That volume has doubled in just 14 months. You're watching exponential adoption of a payment system designed specifically to bypass dollars. But it's not just the volume, it's who's using it and what they're using it for. Saudi Arabia signed a bilateral agreement in 2023 to accept yuan for oil purchases. Think about what that means for a moment. For 50 years, the petrodollar system meant that if any country wanted to buy oil, they first had to buy dollars. That requirement created automatic demand for our currency, regardless of our economic policies. Saudi Arabia accepting yuan breaks that monopoly. The UAE followed with their own bilateral yuan settlement agreement. Brazil joined for trade in agricultural commodities and manufactured goods. According to the Atlantic Council's central bank digital currency tracker, over 40 countries have now signed bilateral agreements enabling direct yuan settlement for trade. Each agreement represents trade volume that previously required dollar conversion. That conversion requirement is what gave us leverage over global commerce. That leverage is systematically being eliminated, one bilateral agreement at a time. Let's talk about the gold numbers in detail, because this is where the mathematical proof becomes impossible to dismiss. China's official gold reserves stood at 2,264 tons as of their last full disclosure. But here's what the World Gold Council's research reveals. China's actual gold imports and domestic mining production suggest holdings exceeding 5,000 tons. That's more than double what they officially report. The gap between official disclosure and probable reality represents gold accumulation they're deliberately keeping off the books. Why does that matter? Because at 7.7% of total reserves, gold now represents the highest percentage in modern Chinese financial history. But if the real number is 5,000 tons or more, the actual percentage could be approaching 12 to 15% of true reserves. They are not just diversifying, they are preparing for a monetary system where physical metal matters more than digital promises. For context, the United States officially holds 8,133 tons of gold, representing about 76% of our reserves. Though we should note that Fort Knox hasn't had a comprehensive audit since 1953, but that's a different story. The point is that major economies historically held most of their reserves in gold because it's the only asset that does not depend on another country's promise to pay. China is returning to that model at speed. The Swiss customs data tells the story with precision. Swiss gold refiners, which process the majority of the world's gold into investment-grade bars, exported 1,068 tons of gold to China in 2024 alone, according to Swiss Federal Customs Administration data. That's freshly refined gold moving east in quantities that rival the total central bank holdings of many entire countries. Switzerland doesn't produce gold, they refine it. That metal is coming from Western investors and Western vaults, getting melted down, refined to Chinese specifications, and shipped to Beijing. Now here's where the institutional positioning reveals the timeline isn't theoretical, it's already operational. In October 2024, all major Chinese commercial banks completed full integration with the mBridge platform. We're not talking about pilots or tests. According to official announcements from the Bank of China, Industrial and Commercial Bank of China, and China Construction Bank, full operational integration is complete and live. What does that integration mean in practice? Let me walk you through a specific transaction to make this concrete. A Chinese company needs to buy $10 million worth of oil from Saudi Arabia. Under the old system, here's what happened. The Chinese company bought dollars, transferred dollars through SWIFT to a correspondent bank in New York. That bank verified the transaction, moved the dollars through the American banking system, converted dollars at a Saudi bank, and finally the Saudi oil company received payment. Every step of that chain went through dollar-based infrastructure where American institutions could monitor, approve, or potentially block the transaction. Under mBridge, here's the new reality. The Chinese company transfers digital yuan directly to the Saudi oil company's central bank digital currency wallet. The transaction settles instantly through the mBridge platform. No dollars involved, no American banks involved, no SWIFT message that American intelligence agencies can monitor. The entire transaction is invisible to the traditional financial system. It's like two people handing cash to each other. There's no record of it flowing through anyone else's hands. CEP's volume tells the adoption story with brutal clarity. According to CIPS's own annual reports, the system processed 175 trillion yuan in 2024. That's approximately $25 trillion equivalent. More importantly, that represents a 43% annual increase from 2023. When you see 43% year-over-year growth in financial infrastructure, specifically designed to replace dollar transactions, you're watching a sea change happen in real time. That's not gradual adoption. That is explosive growth that suggests countries are actively choosing to route transactions through the Chinese system instead of the American one. Here's the institutional behavior that confirms insiders know what's coming. Goldman Sachs didn't just raise their gold price target to $4,900 per ounce randomly. Their research note from December 2025 specifically cites sustained central bank demand from emerging markets as the primary driver. Translation, they see the same repositioning we're describing, and they're positioning their institutional clients accordingly. When Goldman moves, it's because their big clients, the sovereign wealth funds managing hundreds of billions, the pension funds controlling trillions, the family offices of the ultra-wealthy, have already started repositioning their portfolios. JP Morgan's commodity research desk made similar moves. According to their Q4 2025 outlook, they project sustained elevated gold prices through 2026, driven by reserve diversification away from traditional reserve assets. That's banker speak for central banks are dumping dollars for gold, and this trend is accelerating faster than historical precedent. But here's the specific institutional move that tells you the timeline is real and imminent. In November 2025, China's State Administration of Foreign Exchange issued detailed 127-page guidelines for the enterprise divestment mandate. These aren't vague policy suggestions. The documents specify exact asset categories that must be liquidated, precise timelines for different asset classes, repatriation requirements with specific deadlines, and compliance mechanisms with penalties for state-owned enterprises that don't meet the schedule. The November 2026 deadline isn't arbitrary or flexible. It's a coordinated trigger date that allows Chinese institutions exactly 12 months to complete orderly liquidation, while the alternative financial infrastructure scales up to handle the volume. Think about the strategic timing here. They're not building the alternative system hoping they might use it someday. They've built it, tested it, scaled it to handle trillions in transaction volume, and set a specific date when the old system becomes completely optional for their economy. One more data point that should crystallize the timeline in your mind. According to the Bank for International Settlements quarterly review, cross-border UN payments increased by 62% in Q3 2025 compared to Q3 2024. That's not gradual adoption. That's explosive growth, suggesting countries are actively choosing yuan settlement over dollar settlement for practical transactions, happening right now. Every percentage point of international trade that shifts to yuan settlement is a percentage point where dollar demand decreases, dollar velocity slows, and the dollar's role as the essential middleman erodes. You want to know the real proof this isn't speculation? The Chinese government is acting exactly like an entity that knows it has a working alternative to the dollar system, has positioned its financial weapons, and has set a timeline for deployment. Their behavior only makes sense if the strategy is real and the infrastructure is operational. Countries do not order $8 trillion in systematic liquidation on a firm deadline unless they're absolutely certain they have a functioning alternative ready to go. The historical precedents show the pattern with clarity. The current data proves the execution is underway. The institutional positioning reveals the timeline is locked. November 2026 is not a prediction. It's a deadline that has already been published in official Chinese government directives, and the countdown is running whether American investors are paying attention or not. Now let's do the math that Wall Street doesn't want you to see. Because when you actually calculate the scale of what's coming, the numbers stop being abstract and start being terrifying. We're not talking about market volatility or a typical correction. We're talking about coordinated selling pressure that dwarfs any financial crisis in modern history. Here's the trigger sequence. China still holds $688 billion in U.S. treasuries. That's what remains after they've already dumped 47% of their peak holdings. Now add the November 2026 enterprise divestment mandate. $8 trillion in Chinese state-owned enterprise holdings across Western stocks, bonds, real estate, and business assets. When you combine those two numbers, you get $8.7 trillion in coordinated liquidation hitting the market within a compressed time frame. Let me give you context for that scale. The 2008 financial crisis, the event that nearly collapsed the global financial system, was triggered by Lehman Brothers' bankruptcy. Lehman's total assets at collapse were $639 billion. The panic that followed evaporated trillions in market value, froze credit markets worldwide, and required unprecedented government intervention to prevent complete systemic failure. That was $639 billion of sudden, unexpected default. China is planning $8.7 trillion in systematic coordinated liquidation. That's not one company failing unexpectedly. That's the world's second largest economy deliberately pulling out of dollar-based assets on a published schedule. Do the division. That's 13.6 times larger than the Lehman collapse. Actually, let me be more precise. It's 200 times larger than the catalyst that triggered Black Monday in 1987, when $1 trillion evaporated in a single day from roughly $40 billion in foreign institutional selling. Think about what happens to prices when supply overwhelms demand by that magnitude. Imagine you're trying to sell your house, but suddenly every house in your city goes on the market simultaneously with sellers who have a firm deadline to complete the sale. What happens to prices? They collapse because there aren't enough buyers to absorb that volume. That's what's coming for Treasury bonds, for stocks held by Chinese institutions, for any asset where Chinese state-owned enterprises have significant exposure. But here's where it gets worse. Markets don't absorb selling pressure linearly. They cascade. Let me walk you through the mechanics of what happens. Chinese institutions start liquidating to meet their November 2026 deadline. That selling pressure drives prices down. When prices drop, it triggers stop-loss orders from other institutional investors who have risk management rules requiring them to sell when assets fall below certain thresholds. That automated selling drives prices lower still. As prices fall further, margin calls force leveraged investors to sell to cover their positions. Each wave of forced selling creates the conditions for the next wave, and the cycle accelerates. This is exactly what happened in 1987, in 2008, and in every major market collapse. The difference is scale. The 1987 crash required massive Federal Reserve intervention to stabilize. They had to inject liquidity, coordinate emergency rate cuts, and essentially promise unlimited support to prevent complete systemic failure. That was for a crisis triggered by selling pressure 200 times smaller than what China has scheduled for November 2026. Can the Federal Reserve intervene again? Of course. Will they try to buy treasuries to stabilize prices? Absolutely. But here's the constraint they face that didn't exist in previous crises. China has built a functioning alternative to the dollar system. In 2008, there was no viable alternative to dollar-based finance. Countries had to come back to the dollar system because nothing else could handle global trade at scale. In 2026, Enbridge will be processing trillions in transactions. CIPS will have years of operational track record. And dozens of countries will have direct UN settlement agreements operational. The Federal Reserve's leverage to force everyone back into dollars after the crisis is dramatically reduced. Now let's talk about what smart money is doing right now, because institutional positioning tells you everything about who sees this coming. Goldman Sachs is projecting gold at $4,900 per ounce by the end of 2026 because they think inflation might tick up a bit. They're projecting that price because they're modeling sustained aggressive central bank buying that continues to accelerate. Their December 2025 research note specifically mentions that emerging market central banks are on pace to purchase over 1,000 tons of gold in 2026, which would shatter previous records. Current gold prices around $4,045 per ounce already reflect some of this demand. But here's what changes the equation. Right now, most of the world still believes the dollar system is permanent and Chinese repositioning is just routine portfolio diversification. When the November 2026 liquidation actually begins, when the scale becomes undeniable, you're going to see panic buying of gold by institutions that waited too long. Goldman's $4,900 target might actually be conservative if crisis dynamics accelerate. Silver deserves specific attention because the supply-demand fundamentals are even more extreme than gold. According to the Silver Institute's annual survey, global silver mining faces a structural deficit of approximately 200 million ounces annually. That means demand consistently exceeds newly mined supply, and the gap is being filled by drawing down existing inventories. How long can that continue? Not indefinitely. Silver has industrial applications that gold doesn't. Solar panels, electronics, electric vehicles, medical equipment. As countries rush to build energy independence and reshore manufacturing in response to supply chain vulnerabilities, industrial silver demand is projected to increase dramatically. The USO solar industry alone is projected to require over 85 million ounces of silver annually by 2030, according to Department of Energy assessments. If you combine that increasing industrial demand with investment demand from people fleeing dollar assets, you get a price squeeze that could move dramatically faster than gold. Here's the opportunity most people aren't considering yet. Reshoring. For 40 years, American companies outsourced manufacturing to China to reduce costs. That strategy is about to reverse forcibly when November 2026 hits, and Chinese divestment makes Western Chinese economic integration untenable. The infrastructure required to bring manufacturing back to North America is massive, estimated at $183 billion in reshoring investments according to the Reshoring Initiative, this 2025 report. Which companies benefit from that? Defense contractors who are already required to maintain domestic supply chains. Energy independence companies developing alternatives to imported oil and gas. Semiconductor manufacturers who received subsidies under the CHIPS Act to build domestic production capacity. rare earth element processors building capability to replace Chinese supply chains. These companies represent ways to profit from the coming fragmentation of global supply chains. But let me give you the specific timeline that matters for positioning. We're currently in early January 2026. The November 2026 divestment deadline is 10 months away. Here's what institutional investors understand about crisis timing. You don't wait until the crisis begins to reposition. You position in advance because once the crisis is obvious to everyone, prices have already moved and opportunity has vanished. Think about 2008. If you knew in January 2008 that Lehman would collapse in September, what would you have done? You would have repositioned aggressively. You would have reduced exposure to vulnerable assets, increased allocation to safe havens, and positioned for the opportunity that follows crisis. The people who waited until September to react watched their portfolios collapse before they could act. We're in the January 2008 equivalent moment right now. The difference is that this time the crisis has a published date attached. China has literally told us when they're pulling the trigger. November 2026. The institutions know this. Goldman knows. JP Morgan knows. That's why they're repositioning client portfolios now in Q1 2026, while most retail investors are still completely unaware. Here's the final calculation that should crystallize everything. China's 13 consecutive months of gold buying didn't happen randomly. Their Treasury holdings hitting a 17-year low wasn't accidental portfolio rebalancing. The operational deployment of mBridge wasn't just testing new technology. These are three components of a single coordinated strategy, and all three reached critical operational status simultaneously. The three weapons are armed. The alternative financial infrastructure is operational. The deadline for liquidation is published. The mathematical sequence is inevitable unless something fundamental changes in the next 10 months. What could change? China could reverse course, abandon mBridge, cancel the divestment mandate, and return to dollar dependence. Does that seem likely given everything they've built and positioned? Here's what smart Americans are doing right now. They're reviewing their portfolio exposure to dollar-based assets that Chinese institutions might be forced to sell. They're considering allocation to precious metals before crisis buying drives prices to Goldman's projected levels. They're researching companies positioned to benefit from reshoring and supply chain reconfiguration. They're acknowledging that the next 10 months represent a positioning window that's rapidly closing. This isn't about panic. This isn't about fear. This is about recognizing patterns, understanding mathematical inevitability, and making informed decisions while you still have time to position rather than react. The institutions are positioning now. The smart money is repositioning now. The question is whether regular American investors will see this coming or whether they'll be the ones forced to sell at the worst possible moment when crisis cascades begin. Remember the opening question. What happens when the world's second largest economy stops buying your debt, starts hoarding the one asset you can't print, and builds an entirely new financial highway that bypasses your currency? You're watching the answer unfold in real time. The $8 trillion weapon is armed. November 2026 is when it fires, and the countdown has already started. The only question left is whether you're positioning for what's coming or whether you will be caught in the cascade when everyone else finally sees what AG has been showing you today. The math doesn't lie. The timeline is published. The choice is yours. If you made it this far, you're exactly the kind of investor who sees what others miss, and that's why I do this. Hit that subscribe button and drop a like to help me keep bringing you the financial intelligence Wall Street does not want regular Americans to have. Stay sharp out there, and remember, the best defense against their weapons is your awareness of them.